Hello, everyone, and welcome to the Nasdaq Dorsey Wright podcast for the week ending on September 2nd. My name is Ian Saunders, and we are thrilled to be joined today in the office by John Lewis,
In the
all the way from
office.
California.
Yeah, that's right.
It's great to be talking to you face to face here, John.
Yeah, good to see you.
Yeah. So we are recording this podcast a little bit earlier, but by the time this podcast does come out, it's going to be the first podcast we have in the month of September. So it was, as I feel like we started off almost every podcast for the past several weeks saying no shortage of market movement over the course of the past week. And this summer has been no shortage of market movement, that's for sure.
Yeah, for sure. So since we're doing this a couple days early, we got a high wire act without a net. So I think that'll be the theme of this podcast. I'm sure we'll be wrong by the end of it. So
yeah, right.
When a podcast
we'll come out super bearish and then it'll just be bullish by then.
That's right. That's what we'll do.
But given that kind of we are recording a couple days early, we felt it would be best to maybe take a step back and just kind of look at movement that we've seen over the course of the past few weeks, few months. It's been a lot going on this year and a lot of negative movement, unfortunately, especially on the momentum side of things, which is where we're trying to attack the market most of the time. And I think that a good way to show that, at least on the platform, is through what we call kind of a quilt. We're simply taking year-to-date returns of different representatives and then stacking them up against one another for multiple years to see, okay, we understand that momentum might have been the best performing factor in 2019 and 2020, but that hasn't been the case in 2021 and 2022, right? But we have seen a little bit of a resurgence, right? We did, in looking at a broad factor quilt, looking at 10 broad or 8 broad factor representatives from 2007 to 2022. 2021 saw momentum being the worst performing factor, so positive on the year, but the worst performing factor out of those areas examined. A little bit of a pivot from areas that we'd seen recently. Value did a lot better than we had seen. 2022 momentum's no longer the worst. It's second to worst now, but no longer the worst, at least from what we've seen over the past few weeks.
Yeah, exactly. So we just have to outrun, your buddy, not the bear, right? So the momentum is gotten off the mat a little bit. And I think what's interesting so far this year about momentum, when you look at the different buckets of momentum, the leaders and the laggards and things like that, it's been more important, I think, to avoid the laggards rather than get the high momentum stuff right. Mm-hmm. The high momentum stuff is just kind of with a lot of the other factors mushing around in there. And then the laggards have been really, really bad. So I think it's been a tough year with all the back and forth. There's been a lot of intermediate term trend changes. For example, energy, really good, really bad, really good. And that kind of thing is always really hard for momentum to handle. I think the good news is that never lasts forever. Look, maybe this time it will. I doubt
never
it.
Say never.
It's never happened before. These kind of choppy markets, we always come out on the other side with some trends and things that you can capitalize on. Now, whether we have the leadership now or whether we're going to have to go through kind of another cycle to find it is to be determined. But we will get some trends and we will get some sustained leadership. And then, once that happens, we'll be in really good shape.
And I think that, we've talked about that with just the momentum representative we're using here, but in momentum used kind of across the platform or across a lot of our strategies. There's periods of maybe the underperformance do tend to be followed by that kind of significant. Is that just kind of capturing the leaders, and then once they start to really lead for a long time, is that kind of what it's looking at?
Yeah. So you're right. So these periods of underperformance actually are really good times to look at getting into momentum strategies, because essentially what's happening is that those periods of underperformance refresh the portfolio. So the leadership cannot grow forever. At some point, it has to stop. Now, you don't know whether that's going to be a couple months or a couple years, but no tree can completely grow to the sky, right? At some point, there's a limit. And the only way to refresh a momentum portfolio, since it's based on performance, is to get things to underperform. Right. So when you get these periods of underperformance, you cycle out the old leadership, you cycle in the new leadership, and then that is kind of that pause that refreshes a momentum portfolio. It's actually part of the process. It's gone on longer than it normally does in this case. So having momentum be just, at the bottom of the barrel in 21 and then kind of second to last in 22, that's not a normal thing, but we are in kind of one of these pauses that right now, like, this is the time to look at getting more aggressive with momentum rather than when it's at the top of the heap and everyone really wants it.
That makes sense. And I mean, we're seeing a kind of a little bit of, at least like we said, over the course of this year, it's not last anymore. But in looking at some of the different ways that we can maybe kind of quantify momentum, or at least depict the kind of momentum environment, right? I know one that you follow and that you can bring to our attention a lot is that RS spread.
Yeah, so the RS spread just measures a basket of leaders versus laggards, right? And when the leaders are doing better than the laggards, that's decent for momentum. So the leaders can be doing better just if the laggards are doing horribly, which is a little bit what we're seeing right now. But on the Dorsey Wright site, we upload that indicator every day. It's RS spread. Kind of all one word, and you can see it. It's been moving sideways for quite some time. We haven't had a lot of traction there, but recently it's kind of broken a double top, moving higher. It's not something that we're super excited about, but it's not really going down anymore. So it's kind of stabilized here, starting to look like it wants to move higher. If it breaks out of this big sideways consolidation pattern that you'll see, that'll be a really good sign. And by the way, if it does that, and you're not looking at the chart now, like, we'll let you know when that happens, because that'll be a pretty significant breakout to the upside. So, right now the momentum stuff doesn't look, it's not like we're screaming from the rooftops about how great it is, but there's some signs there that we're starting to get better. We're starting to see some improvement in that area.
And I mean, so what is the actual calculation measuring there with so it's at what, 15% now? So that's just the performance spread between?
Yeah, so essentially what we do every day, we take the percentage difference between what happened to the basket of leaders and what happened to the basket of laggards, and then we just kind of aggregate those over time like you would any other index. The basket of leaders and laggards, we reconstitute that stuff every month, and it is just based on a very academic definition of momentum, so 12 minus 1 momentum. There's nothing fancy about it, and we use a basket of mid and large cap stocks. We use a Nasdaq mid and large cap index to constitute that. So it's very straightforward monthly rebalance, and you kind of get an idea about what's doing well, what's doing not when you look at the overall kind of allocation of that index. We don't allocate it top down; it's all just bottom up, stocks there.
And so seeing that, I mean, looks like it hit its peak, or at least 10-year peak in May of 2020?
Yeah, exactly. And so that was, obviously a good time for momentum. When you think back to 2020, a lot of the software stocks, the stay-at-home stocks, I feel like we haven't talked about that for like a year.
But forgot that was a term.
Yeah, right. A lot of that stuff was doing really well, and then that reversed, and you had a big laggard rally with all the consumer cyclicals and stuff like that started to do better when some of the restriction eased and stuff like that. We haven't made it past that peak. We've just been kind of moving sideways. And that's really reflected going back to that quilt that you brought up earlier, which, 2021 wasn't a great year. And then 2022 so far hasn't been great, but we're starting to see that kind of move off the bottom.
Yeah, I mean, it's been a lot of movement. It's a wide trading range, I guess. You call it a trading range, I guess, for this, but it is a wide range. Like, we've seen a fair amount of kind of wide ranges in a lot of other areas. And I know, so the leader versus laggard concept. I mean, one way that we kind of look at that pretty frequently, I guess, in the whether it's in the report or whether it's in the other videos that we do, is just through kind of like sector dispersion, right? I mean, that's a lot of times where you can kind of see that breakdown. And we've seen a lot of movements from a sector dispersion standpoint, just in looking at the broad State Street spider funds kind of stacked up against the S&P. If you were to guess, what would be the best performing sector fund, John, over the past 30 days?
Over the past 30 days?
Past month.
Over the past month, maybe energy over the past month.
Energy over the past month, up 6% over the past week and 7%, a little over 7% over the past 30 days. They're through market movement on Monday, the 29th, at the time of this recording. But only 2 sectors are in positive territory over the past month. I mean, saw a pretty big sell-off across a lot of those areas that maybe had seen a little bit of a rebound last week, right? The S&P was down 4%. So a lot of those areas that had improved got a lot worse pretty quick, right?
Yeah, definitely. So we saw, a bunch of short-term mean reversion from that kind of old leadership stuff. It's given a lot back today as we do the recording, but it's been kind of this really, really volatile back and forth type of pattern where it seems like, if you don't like your portfolio this week, maybe next week you'll really like it. So that's why 2022 has been so difficult. And it's been really hard to find sustained leadership that just kind of keeps going and going. It's very, very much kind of this back and forth movement that we've been seeing, really volatile, and you can look really smart one week and then really dumb the next. And I think that's kind of been what's happened to everybody so far this year, no matter what you're doing, whether it's momentum or value or whatever. It's just been tough across the board.
Yeah. I mean, even with, that back and forth movement in energy, the energy State Street Spider Fund, XLE, is still up 51% on a year-to-date basis.
Yeah.
That's just kind of crazy to think about, even with these big, huge downswings. Your gas is probably a little cheaper here in Virginia than it is out in California.
Slightly.
But we're back under $3.60 60 cents a gallon over the course of the last week. So it's just
I would be very happy for that.
But seeing that, that's a buck cheaper than it was 6 weeks ago at this point.
Yeah, definitely, and even gas in California, knock on wood, has come down. Who knows if that'll stay? But the other interesting thing about energy too is that it's a really interesting sector right now, because we're getting wild swings in energy. We're getting really good performance out of energy, but it's so small in the S&P 500. Right, it's so small of a sector weight that it doesn't really make a whole lot of difference what it does in terms of the overall market averages. If you're an active manager, it makes a huge deal. Mm-hmm. But you can be massively overweighted with 8%, right? If you could have 15% and then you're like really overweighted. But that when those sectors get to be real small like that, that generally comes after years of compression and underperformance, which energy had. And then it's always an interesting phenomenon, because you can super easily overweight it. You can get way too much weight in it relative to a benchmark. And all these swings don't affect the S&P 500 a ton from an attribution standpoint, but they can really make your portfolio go if you know what you're doing.
Right. And a lot of the momentum side, they have been more overweight towards the energy, the material side of things, which
for sure
made things a bit more rocky, but for sure. But
yeah.
has maybe helped out with a little bit of that, at least not the worst performing areas that we've seen. And different strategies have performed differently. Those that utilizing the platform can take a look at the models page and see some different areas, different ways that we're kind of looking towards the momentum space. But like we've seen, no shortage of movement that we've seen from the sectors, from the spreads, from the quilt movement. We're heading into September, right? School's back in session, maybe, hopefully, for those that are listening. Where are we kind of looking at for as we move out throughout the rest of the year? There's a lot of movement. Are we going to September is usually not a great month for the markets, right? But we doing some of the volatility testing that we were doing earlier this week. It's actually tends to be one of the least volatile months, just from a strict plus or minus 1% days for the S&P, sees a lower amount of those extreme days than any other month on average. Probably some outliers sprinkled in there that kind of skew that data a little bit, but nonetheless should make up for a pretty interesting September.
Yeah, I think the fall will be really interesting. I would expect there to be more volatility, right? The Fed's really going to try to jawbone this inflation down. What they want to do with actually moving rates around is, they're in a tough spot, because they've got this inflation problem. They've also got a recession problem. Like, they're in a real tricky spot. So they might just try to do a lot of talking and, try to manipulate the markets that way if they can. But we're going to have some interesting things coming down the pipe with the election and, midterms and all this kind of thing. The other thing that everyone's been talking about, right, and we talked about it earlier, is this 200-day moving average deal, right? So the market, that's been kind of all over the financial press. The market, as S&P 500, hit that 200-day moving average and reversed pretty quickly. And everyone's kind of freaking out about that. And I think that's not really what we should be doing. The market doesn't generally just blow through that 200-day moving average on the first go.
It's a notable resistance, right?
Yeah, it's definitely notable. It takes a few tries to get through that. And so I think in September, that'll be kind of a big story, right? Coming back up to test that, how many times we do it and that sort of thing. So that'll be kind of the next big hurdle for the market to get over.
And I think, with today's move, we're crossing down beneath the 50-day moving average, right? Which is very short term in nature that we can see. And we see, so we're talking about the S&P 500 and looking at that the 20-point chart of the S&P, I mean, we still have some notable support in there around the 39.20 range, kind of matches up with that bullish support line that we see on that chart. But we also, I mean, we got into overbought territory on the S&P for the first time in quite a while in this downturn. So, I mean, we were kind of talking earlier, it's maybe not that surprising. You pair that overbought territory with the 200-day moving average to see, I mean, a little bit of, you can't go straight up forever, right?
Yeah, absolutely. And the breadth thrust, right? All those things that we were talking about in, the beginning of the summer that we thought were really bullish for the market, that has to kind of come back at some point, right?
Mm-hmm.
Like it can't just be this massively overbought market forever. So we're probably seeing some of that as well, that market coming back. Now, look, this pattern did come up in 2008, I think, right? Where, it hit the 200-day moving average, fell down below the 50. That's not great. But I mean, look, we're not in a great market right now, but this is a pretty different scenario to 2008. I mean, that was a whole different ball of wax. Like we don't have banks teetering on the edge, like an entire industry teetering on the edge of going out. Well, maybe crypto stuff, but that's another story. But I mean, we're not in this kind of liquidity crisis mode, at least now, that we were back then. So I mean, I think things are a little bit different, if that pattern emerges, but we'll see how it all plays out. Yeah.
I mean, I think it'll be pretty interesting to monitor there. And I mean, and seeing, I mean, we're right smack dab in the middle of that 10-week trailing trading band with today's move. I mean, so seeing it back off, I mean, that kind of normalization, like you were talking about, and a lot of those numbers that I remember from the various breadth thrusts, whether you're looking at BPs, whether you're looking at positive trends or the 10 weeks, I mean, you get some different movement throughout a lot of those historical environments until you get to like 3 to 6 months out. Then the stuff really starts to really kind of be consistently positive a lot of times.
Yeah, and I think that this market is going to grind everybody up and spit them out, right? That's what it's going to do. It's going to pick everyone by the ankles and shake all the nickels out of their pockets, right? It's going to be difficult, and when people start giving up, when they start throwing in the towel, then that's probably when the markets start to go again. I mean, we rallied off the bottom very significantly. Everyone was summering, not paying attention, and then they come back to, oh my God, the market just went up 20% and I haven't been paying attention, right? And so now the market's going to grind them out, and this is what it does, right? This is not easy. The returns out of stocks are really good, but the ride is bumpy. Right. And so I think, we expect that. I think the thing to do is just to keep doing what you're doing, right? Follow the indicators, follow your process, and it kind of works out, unless you really kind of panic and do some things you're not supposed to do, because the market's going to make everyone look really dumb sooner rather than later.
Now's not the time to be changing that game plan, right?
Yeah,
you stick in the game plan moving forward. That's right. The name of the game.
Yeah.
Great. John, I mean, I think we've covered most of what we were looking to cover here. I mean, anything else you want to hit on?
No, I think we got it.
Cool. Well, as always, it's great to have everybody listening. Great to be able to talk to you here in person, John. Hopefully we'll be able to get some more of these in the near future. Not that we want, you don't have to fly back out here every week, but it was great to have you here, and hopefully great for all of those listening. Thank you very much for tuning in, and we look forward to having you back next week.